welcome to the Mutual Fund Show. I'm Nimesh Shah, and over the next 25 minutes, we'll get in a lot of intelligence about FY22, the year gone by from a mutual fund investors' perspective, and what FY23 could hold in store. It's the last show of the financial year, and it's our pleasure to get in. Mr. Nimesh Shah is Managing Director and CEO of ICICI Prudential AMC, with his thoughts on the year gone by and the year ahead. Mr. Shah, great having you. Thanks for joining in.
Thank you. Thank you for having me. I did the last show last year also. So it's good having this last show of the year. Huh?
Yeah. It's a special show in many ways, and therefore it's great to have you. Again, if we thought at the end of FY21 that now the volatility is past, the uncertainty is past, and FY22 might be a normal year, we got anything but a normal year. What were, as a mutual fund manager and as a mutual fund investor as well, what are the key learnings for you in the year gone by?
Actually, mutual fund investors should be super happy this year. Why I'm saying that, it is not only because of the growth of the market, but it is the broadening of the market that one is very happy with. Remember last year, exactly 1 year back when I came to your show, I was trying to explain that the rally in the markets is quite a narrow rally. There are 10 stocks, and we had discussed all the data that 10 stocks have given so much return, while the rest 40 stocks have not given return, and the rest of the market is lagging behind. This year has been a year of market broadening and the broad rally across the stocks. So mid caps have done better than large caps. Small caps have even done better. So those quality names which were doing very well earlier, say in 18, 19 and 20, have not done well in 21, 22, and the rest of the market has really picked up. So mutual funds would be very happy, and investors in mutual funds would be very happy, because the market is, and mutual funds are diversified instruments by nature. So in a narrow rally, they never do well. In a broad rally, mutual funds always do well, right? So that's the beauty of this year. So for mutual fund investors, this would be a much better year than the years before that, because their funds would have done much better. So broadening of the market is the single most theme that I would talk about for 21-22. And volatility, as I said last year also, it has just started. I would say it has just started. And we'll talk about that as we go forward. I think volatility is only increasing from here where we are. I had said the same thing last year, and I continue saying it, that volatility in the Indian markets will only increase. The levels at which we are today, the levels at which the rest of the world is, and what is happening in the rest of the world is going to bring in a lot of volatility, and we can discuss that in much detail going on.
Yeah, we will, and I'll talk about that, because how would you foresee FY23? I think in that a conversation of this will come, but I'm just trying to understand. So the standout feature of FY22 was broadening of the market, but for you, who also invest into mutual funds per se, what was your key learning for FY22?
See, one of the thoughts that we always had is last 10 years, it is not last 1 year. Last 10 years, whenever I've come to your show, I only talked about volatility, right? And how mutual funds should gain out of volatility. Now I'm very happy that the whole market is talking about it. Say even 10 years back, I would come and talk about balance advantage fund. Right. So now, if you see the performance over 10 years of balance advantage fund, it is so satisfying that you have given the balance advantage fund, after taking substantially lesser risk, has given a very good customer experience. It is way beyond our expectation also. So one thing, the success of balance advantage fund in the last 1 year or the years before that clearly shows that mutual fund has to be very, very alert as to what is happening in the market, and you cannot have a stagnant equity allocation irrespective of what is happening in the market. So right when the markets become 53,000 in the current last 2 months, when the markets corrected to 53,000, the asset allocation in equity should have gone up, and the debt component should have come down, and vice versa. As markets again approach 58,000, again equity allocation has to go down. So that principle is very, very established. I'm very happy that the whole mutual fund industry has got into balance advantage funds now. Now, earlier, whenever I used to see, even I was the only guy talking about balance advantage series. Now, whichever advertisement you see of whichever mutual fund house, it's very satisfying that the whole industry is talking about. I think this category will become bigger than equity category also in mutual funds. So that is what is happening, that volatility, with our expectation of volatility only increasing from here, this category will become very big, because it may be because the levels at which the markets are already, right? It might be that you can make money out of volatility and not necessarily money out of holding, right? Just because you hold some stocks, it is not necessary that you make money. But if you have got a very tax efficient structure like a mutual fund, and there is volatility, and your scheme is supposed to trade in that volatility, then it can be a very good instrument for the final person.
Well, it'll be lovely to have a conversation with Naren at some point of time about how is he doing trading this volatility that you are so talking about, because I'm sure it's probably forming the ethos of some of the schemes as well. But Mr. Shah, is that how you foresee FY23 to be? That it'll be a year.
We believe the next 12 to 18 months will be extremely volatile because of various reasons, global reasons, right? Whether whatever is happening in the Ukraine-Russia front or whatever is happening in the USA, right? Because of the external world, there is going to be a lot of volatility in the Indian markets. And we need to learn, because last 6 months has been unprecedented. If somebody would have told you that in 6 months time, FIIs are going to sell 240,000 crores of equity and still will be at 58,000, you would have said, I've lost my mind, right? But that's the kind of force. Even in this month, if you see the kind of flows that are coming into mutual funds have withstood all the selling of the FIIs. I think it's only the DII versus FII which is going on in the market. So I believe that at the levels which we are right now, there's no issue in India. India is doing well, right? Overall, with the oil prices at which they are, also, I don't see a serious issue. There will be adjustments. There will be some companies which will not make money, or which will make lesser money, or which will grow much lesser than what is envisaged. That will be internal. But macro-wise, even after the oil prices at the current level, it is not that Indian macros are getting extremely hassled. So that's a very positive trade. We are comfortably placed as far as India is concerned. But volatility will come from the external world, and it can come in a big way.
It's interesting. So you're saying at 100, I mean, just a macro question thrown in, it's not a mutual fund question, but since you brought it up, you comfortable with dollars circa 110? Because a lot of belief is that it will cause India to either overshoot the fisc or compromise on the capex.
I'm not saying I'm comfortable. Of course, it is an effect. I am saying that India has the strength to withstand that.
Okay.
Right? Unlike earlier, where you used to get worried, with our forex reserves, with our ability to generate more tax revenues, with GST revenue increasing, with direct taxes revenue increasing, both on the fiscal as well as current account side, we have the strength to withstand $110, unlike what had happened in earlier rounds where we are vulnerable. We are no longer vulnerable to that extent. Will it affect us? Definitely it will affect us as a country, but not to the extent that it would have happened 3 years back, 5 years back, 10 years back.
Point well taken. Okay, so if volatility is going to be the name of the game for the next 18 months, and if the broadening of the market has already started, I'm giving you a bit of a choice question here. But if I know balance advantage funds might be the primary criteria, but if one is looking at pure equity fund and simple bifurcation between large cap, mid cap, small cap, or I'd throw in a flexi cap as well, what do you reckon is a better bet for an investor who's willing to bet right now and hold it for the next 3 to 5 years? What category of funds?
Actually, mutual funds have got a huge category called, whether you call it large and mid cap category or whether you call it flexi cap category. Mutual funds have that optionality. Within that, I prefer large cap more but give us the flexibility. At some point of time, right now, large cap looks like a better risk return reward. But over a period of time, always give a flexibility to the fund manager that when the world changes, we are able to change with that world. Sure. Suppose there is a deep correction in the mid. So I always prefer giving flexibility to the fund manager across capitalization. Don't restrict him into schemes which have got a very fixed capital, this one. So I would always go for flexi cap in that category. And there are a lot of possibilities within there are value funds also. Value funds also can be flexi fund. So there are possibilities within the flexi funds, value funds. This is because this is not, I'm not talking about broad market, this one. Say there is a value fund also, because those stocks which have not done well over the last 5 years, last 1 year, they have done very well, right? We have got a value fund, which was not doing well till 2019, 2020, which is doing exceedingly well in the last 2 years since COVID, right? That is the segment that has come live again, right? So even in a value category, you have got this, you can go across market capitalization. But if you ask me clearly, I prefer today, ICICI Prudential is more focused towards large cap than mid cap and small cap, because some of the valuations have really run up. But again, it is a stock pickers market. Within that, within industries, there are a lot of value picks available. So I am more moving towards value rather than being fixated over which market cap do I go.
Got it. Okay. Can I also request you to tell us that if you were, and I know one size doesn't fit all, what fits for you doesn't fit for others, but if you were to make a bifurcation between asset classes, all right, if somebody is not putting money in a multi-asset fund, but choosing to allocate individually, what do you think is the right allocation between equities, debt, commodities, maybe even global equities, presuming that at some point of time you guys will be allowed to start investing again?
So I could not have got a better question than this.
Okay.
We have launched something called as a passive multi-asset fund. Passive multi-asset fund. I have the choice of investing in Indian equity. I have the choice of investing in foreign equity. I have the choice of investing into debt. So there is a lot of flexibility that I have got across asset classes, and I invest in those ETFs. Passive multi-asset fund, the name says it all. So it gives a tremendous amount of flexibility based on the levels of the market. So today we have invested around 50% between equity and international markets. So around 30% plus is in equity markets in India, around 20% is in internationally. My numbers will be somewhat, they are not accurate, but around 50% is into India and foreign equity. Around 38% is into debt. So there are various asset classes. You can invest in gold in that. So some part of it would have gone into gold. So today is the time to give flexibility to the fund manager over the next 2 to 3 years, that invest across asset classes, and that flexibility is also available within fund of funds. So fund of funds is coming out as a very, very important category. Earlier, you used to toggle in a thing like asset allocator fund. We used to toggle between equity and debt. Now I have the choice of toggling between international equity, Indian equity, gold, debt. So it is giving a complete flexibility to the fund manager where he wants to allocate. And it is very clear in our passive asset management fund, and the fact sheet will be out tomorrow, because 31st March disclosures will come tomorrow, and you can see how we have distributed amongst various asset classes.
Interesting. But Moti, you reckon that 50% into equities, 50% into out of the remaining 50%, some into debt, some into commodities is a good allocation.
So international equity, because the state at which Indian markets are, see, Indian markets are 80% premium to MSCI today. So the rest of emerging market is quite cheap. Rest of Asia is quite cheap. If our forward PE is at 20, for MSCI the forward PE is 11. So it is not necessary today. Today it is a thing is in diversifying across countries. Why should we be putting entire money into India itself, where other countries are available relatively cheaper?
Sure, point well taken.
So that is why I feel that passive multi-asset fund is a very good category.
Yeah.
So what we have done during the year is we have created a series of products that where you can do asset allocation the way in a very tax-friendly manner. Asset allocation is possible. So fund of funds, your viewers should understand fund of fund categories very well. It will require basic common sense. You don't have to be a financial wizard to understand fund of funds. You will see where the fund manager is allocating the monies, right? So that's where the spread is between, and we should remember that interest rates are rising. So debt markets are not also very easy to invest in this one. So when people are wanting to park money for a shorter period, also we say floater interest rate is the best possible. In a rising interest rate scenario where you do not have a clear duration call, it is very important to invest in floater interest rates, right? So in debt funds, we have got a scheme called ICICI Prudential floating interest rates, right? So that is a very interesting period today in the scenario that we are in. It might be the right place to invest.
Got it. You preempted my question. I was going to ask you that since it's a year of interest rate rises, would you reckon that that's the
so
thing
floating? I think amongst the debt category, one has to be very alert and be only with floating interest rate type instruments.
Got it. Okay. Well, thank you so much for giving that nugget too. I have two final questions. Last two questions. The first one is on thematic funds. You guys have consistently come out with thematic funds a couple of years before they catch the fancy, and they've given good returns in the past. As a house, what are the themes that you believe, or what are the sectoral or thematic funds where you believe people should actively look at investing in, whether in a SIP fashion or in a lump sum fashion?
In cricket, they call it half volley outside the off stump. So you have given me a half volley outside the off stump. So this is
great for my viewers.
So, and I'm sure this will help your viewers also. Why do we come with so many thematic funds? Because we believe that mutual fund or fund of funds is a great way of investing in thematic funds. So I've launched something called as thematic advantage fund, right? Since last, and you see the track record of thematic advantage fund. It's a good track record. What do we do? Suppose you have got a view on a sector that this sector should do well. Suppose banking sector, we believe today has to do well. Do you know when to exit out of the banking sector? Your investor has to take the decision of entry and has to take the decision of exit also. And when he exits, suppose he invests in 2 months time, your returns come in 2-3 months time, then you will have to pay full capital gains tax on that, right? Short-term capital gains you will have to pay on that. So we have launched a thematic fund of fund where we'll decide which themes of funds should we invest in. So we will invest in those categories that are within the company. So I've got all the themes in the company. I've got banking. So today we believe banking is a very good space to invest because I think private sector banks are beautifully placed. Their balance sheets are clean. Credit cycle will come round, right? We believe credit cycle will be back. We believe that even if interest rate rises, private sector banks will be able to manage their NII as well. They have got a huge market to be taken from the overall banking system in the country. So if we believe that, then there will be a huge allocation in thematic advantage in banking fund itself, right? And when at the right time, we'll decrease suppose banking does very well over the next 2 months, I can decrease the weightage of the banking fund and I can increase. So theme wise, we like our pharma fund. We came up with the pharma fund after 4 years of underperformance. Right? Pharma had not done well till 2019. Between 2016 and 19, pharma had not done well. That's the came with our pharma fund has done very well. After bad cycle of commodity for 4 to 5 years of bad commodity cycle, we had come with our commodities fund that has given an amazing return in the last 2 years. So we will decide the sectors for the customer. And I think for a aggressive investor who wants to take equity investor and wants to invest in themes, there is nothing better than thematic advantage fund. Right? It's a fund of fund which invests in themes and we will decide the entry and the exit point of time. The fund managers, we have created some internal models for that. So if you ask me which sectors we like, as I said, I like banking sector today. Banking has corrected a lot. And so banking sector is one place. Auto is another place where auto has not done well for so many last 2 years. Auto has not been doing well. So auto is another place that we like. One of the themes that we really like very much right now is housing. We believe real estate is going to do very well. For 7-8 years, real estate has not done well. Last 1 year, real estate has started picking up. We believe that the inventory in the country has gone down big time, right? The unsold inventory is all-time low. So with that, we believe real estate is 7-8 years. We like everything after underperformance. So after 7-8 years of underperformance, I think real estate is a good sector. So either you go and invest on your own in houses, but if you don't want to invest in houses, come and invest in what we are launching today is ICICI Prudential housing fund. So it will not only invest in real estate companies, it will also invest whatever goes into housing. So cement, steel, so various industries that benefit out of housing growth in India. The banks itself, which have got a great business of lending to real estate, lending to mortgages. This one. So overall, I think it's quite well diversified because you get banking, you get steel companies, you get you get various sector also you get, because cement is today not, so the cement is expected to do well. So all those sectors are present in the housing fund. So I think housing fund itself is a great opportunity, and we have launched it right now as we are talking. Incidentally, you asked that question, but we have launched that fund yesterday. Right.
Wow.
So next 14-15 days, it's a NFO that is out to offer, ICICI Prudential Housing Fund.
Okay. Well, yes, it is coincidental, but I'm glad I asked you that question because it will help some investors think about thematic funds as well. At least the ones who want to take a slightly higher risk than normal. But this was lovely talking to you about all that's happening around mutual funds. My final question to you, one key advice that you leave our viewers with for FY23, a mutual fund investor.
Asset allocation funds, asset allocation funds, asset allocation funds. That's the message continuously. This has not changed in the last so many years, and that continues, especially for the year going forward, because markets are not expensive. We are sitting on a forward PE of 20 with a lot of uncertainties around the world. So India is doing well. India, there's nothing wrong with India, but there are too many uncertainties around the world, and India is at a substantial premium to the rest of the world. So it is better to go, I'm underlining my message again in the last line, that it is better to, for a series of, whether you take balance advantage fund, whether you take asset allocation fund, whether you take passive multi-asset fund, whether you take multi-asset fund, take any, we have created a whole category of some of funds which have got various allocations to equity. Take your pick out of that, but asset allocation fund should be the mantra.
Okay, with that, thank you so much for taking the time out and being with us, and have a fabulous FY23.
Thank you. Thank you.
The pleasure was ours. Viewers, thanks for tuning into this leg of this very special mutual fund show.